I'll make this promise right now. You're going to learn how to pay less tax this year. Okay? We're going to learn a lot. I'm going to challenge your brain to rethink a lot of things that you have learned wrong, and you will be happy and sad when you leave. You'll be happy that you know better. You'll be sad about what you've overpaid your entire life. So what do you want to learn about today? You saw the flyer, so what do you want to learn about? Saving on taxes.
How to get a refund from all these years I've overpaid.
That's a good one too. Okay, good luck with that one. Yes, ma'am.
Advanced planning for exit.
Exit planning for a business and stuff like that. We'll touch on that. All right, so that's kind of the framework. Everybody's here for the right reasons. Couple of questions to get the frame of the audience. Oh, incoming.
Sorry.
Do you believe income tax rates will, show of hands, decrease? Raise your hands high. By the way, they just went down, didn't they? Stay the same. Go up. Yeah. The reality is the question should be framed, we know taxes are going to go up. How many new taxes are they going to create? That's going to be the real struggle for us going forward, okay? Did anyone under the new tax code feel compelled to write a bigger check? It just wasn't enough tax taken out. Anybody? All right, so the new tax code is a nice tax code, but you do have to change what you were doing. So let me ask this question, because we have a mixture of people here, business owners, et cetera. What should be the maximum state and federal combined tax rate? Now here in California, any CPAs in the room? What are we hitting about now as far as maximum somebody making $1 million a year?
Federal and state,
Yep.
probably 48 to 50%.
48 to 50. So if you're a boss and you could set the number, what would you want the number to be? What's a fair number? Somebody usually says 0.
25.
I got a 20, 25, 25. How about a 26, 26, 28? How about a 28? 33. Here's what the think tank people say. Cato Institute, Art Laffer. Art Laffer's got a great 5-minute video out there about taxes. It's brilliant, L-A-F-F-E-R. Pretty much these guys say that a combined federal tax rate and state tax rate should land between 33 and 37 to create the most efficient economy. That's a fair tax rate, okay? So what's the purpose of the government taxing us? Well, they need money to take care of the needs of the country. Defense, government, welfare, services, et cetera. I call it social capital. In this country, we have a compulsory tax reporting system. You make money, you give money, you sell an asset, you die too rich, you shall surrender a certain portion of that wealth to support the common good. Is that a fair statement? We have to help the country survive. What does the Bible teach about this? Pretty much give unto Caesar what's due Caesar. But do you realize we probably have the most faith-driven tax code on the planet? It is unbelievable what is hidden in our tax code. So, let's look at some efficiencies. When I surrender $1 of income tax payments to the U.S. Treasury and the Franchise Tax Board, that's how much of my tax dollar does something for this country. Paid for the military, paid for government. We lose about 73% in overhead, fraud, waste, and abuse, budget deficit payments, monies to other countries that does nothing for us. 27 cents of your tax dollar actually hits the street. If you run your business with this type of model, how long will you stay in business? Are you excited about giving that kind of money that you kind of work hard to so we can watch them waste 73 cents of it? When I ask business owners and high-income people about this issue, it's not that they don't like paying a tax. They just don't like seeing the tax dollar used so inefficiently. Amen? I give $1 to a worthy organization. So what if the tax code were to be structured where it said, you shall surrender $100,000 this year because of what you've done. We will give you the option to give us the $100,000, or you surrender the $100,000 to your church, William Jessup, something else. Which would you prefer to do?
Sure.
Anybody want to give it to the IRS? I just want to make certain we got the right people in this room. I will share with you, I had one case client years ago, very wealthy family from Beverly Hills. They lived down in the Rodeo Drive or something like that. $250 million estate, and this was 15, 16 years ago. And I asked that question, and he says, Ed, I want to give everything I can to the government. I don't want any tax savings whatsoever for income, capital gains, you name it. And I'm like, I got to tell you, you're the first person ever to tell me that. Why do you feel that way? He said, if it hadn't been for the U.S. Army saving my parents from a concentration camp, I would have never been born. You know what? That's a fair answer. But if I have a choice, that's what I'd rather do. The problem is, you just can't do that. You have to proactively structure things to make something like this work for you. Another quick question. Has anyone received a phone call from the IRS or Franchise Tax Board yet saying, oh, by the way, you paid a lot in taxes last year. We would like to give you some tips to pay less next year. So we have a conflict. They want it all. We want to give part. So let's kind of have some fun with this. The new tax rates are 7 brackets, technically starting at 10%, but theoretically 0 is a tax rate, isn't it? So we had some huge increases in the standard deductions, and these are the 2019 numbers, so they're up a couple of bucks from 2018. California is still just, man, hammer. Capital gains, didn't see much of a change there. So long-term cap gain, depending on the size. California, of course, has no capital gains tax. They just treat everything as ordinary income in this state, but we're not the only state that does that. How about this gift tax thing? Does anybody understand this? So if I wanted to rip out my checkbook and stroke a check to every one of you for $15,000 today, is that legal? It sure is, isn't it? Are there any tax consequences? No. Technically, no, because I'm giving you after-tax money. But if I decide to give Mr. Schaefer $500,000, does the IRS have something to say about that? Is that okay, Dave? Now that check is going to bounce bad, okay? So I give Dave a check for $500. Clearly it's above that number. Is this a gift tax issue? Potentially, yeah. But I could use my lifetime exemption to maybe make that gift tax issue go away. And by the way, this is the highest number we have ever seen for estate tax planning. And how long is this going to be? Well, remember the new permanent temporary tax code we have? This game changes in 2025. So if this becomes a really low number, you might want to talk to your attorney and CPA about capturing this tax benefit before that huge tax benefit goes away. It's huge. Yes, sir.
Did that recently change? I thought they gave that 14,000.
Yeah, it popped up to 15. Yeah. And it's always changing, which is good. So let's go from what we know and to what we don't know. So most of us don't know that 60% of income tax is optional. Most of us don't know that long-term capital gains tax rates are optional. Most of us don't know that 100% of estate taxes are optional. When you're on this side of the room looking over here and you see people like, doesn't he realize he's on a Christian university and a lightning bolt from heaven is about to hit him? Yeah, those are optional. You just got to learn how to make them that way. I'm going to show you how to do that. Here's the new 1040. Woohoo! Has anybody actually printed out the 1040, the actual form? It's like half a page. Who are you? Are you married? Kids? Sign here. CPA sign here. How much did you make? You got any deductions? Add a whole bunch of new schedules and tables and stuff to it. A whole lot shorter. Then the new Schedule A, here it is. It's actually shorter too. You know, modify, you know, here's my medical expenses and taxes I paid and interest and gifts to charities and casual. It's a little shorter than what it used to be, but still theoretically the same. But why do we need Schedule A? Well, we need Schedule A when we have more deductions than the standard deduction. So if we don't have a business or anything going on, depending on your marital status and how you file, that's your standard deduction, which is really generous. And for a lot of givers who don't make a lot of money, they're not going to get to claim their charitable income tax deduction because this covers it. Many of them are actually better off because of this, even though they made some charitable gifts. So that's kind of cool, but some people are kind of like, it's just not fair. Well, that's a huge number now. That new deduction is beautiful. The key thing I want to focus on here is that if we have more deductions than what's the normal, we have to itemize. And the whole purpose of the new TCJA was to reduce the number of itemized filers. That was the goal. And it worked. It was a huge change. But we still get down to this issue. What was your adjusted taxable income? Because there's only a few things below the line here that really help out. So if this number is $1 million, and we've already claimed all of our deductions, and we're in a 50% tax state, that means you're going to take home $500. Does that math work for you guys? Everybody okay paying 50% tax? All right. So if we're going to itemize, and I'm going to focus on this tool right here for tax planning and exit planning, but if I make a gift to the church for check or cash, it goes there, stock goes there, and then that number's there, and it drops down to there, and then it goes back here, and the bigger I make that number, the smaller that number is. Does that make sense? So the smaller I can make that number, I'm saving 50 cents on every dollar. Okay, so that's cool, Ed. Let's put it to work. Here's an income and capital gains tax plate. This is going to hurt your head. 10 years ago, you had $40,000, and you went out and bought 10 investments for $10,000 apiece. Who all likes that one? Raise your hands. All right, who all likes that one? Raise your hands. Who all likes this one? Boy, Richard, you're just a popular guy. Who all likes this one? Oh, it's coming through the iPad too? All right, so who all likes this one? Kind of. And who all likes the loss? Everybody that likes the losses. None of you probably ever had a loss. I'm certain of that. But what happens is we get taught a term called tax loss harvesting. I sell an appreciated asset. I use my losses to help offset that. This is called a participation trophy at the IRS. We're glad you put money at risk. You lost some. We'll let you apply it toward a gain. You do realize you just paid for that tax benefit using your money. I'm not a fan of tax loss harvesting. So when I have this type of situation and I'm looking at this, what if I've made the decision to donate $50,000 to William Jessup? Would you guys accept it?
I would, yes.
Okay, thank you. So I've made the decision to give them 50, and the first thing I do is I go whip out that checkbook, and I do what I've been taught from a child to give money to the church or the kingdom. You remember when you were in Sunday school, 5 years old, they give you the little envelope, you write your name on it, you put a nickel on here, hopefully you can write something at 5 years of age, and then you put the nickel in there and you lick it and you give it to the Sunday school teacher. And from the very beginning of time, we have taught you how to do this wrong. As you grow up, you put a check in the offering plate. It goes right there. Checks and cash. But if I've made this decision to give Jessup 50,000 bucks, maybe a more better thing for us to do, that's a southern term, by the way, sometimes we say mo better. Maybe a mo better way, why don't we take that thing right there? It's plateaued. What are the odds that this thing is going to go up in value? It's probably not good. It's probably going to stay flat or go down. So then the question is, how much longer you guys want to hold on to that? But you know, if you sell it, what's going to happen? Got a tax bill. Got to pay taxes on $40,000 a gain. So I've made the decision to bless Jessup with 50. What if I take that block of stock? Tom, would you guys accept this $50,000 of Apple stock that I've got?
Yes, sir.
Really?
Yeah.
Wow. So they take the 50 and they sell it. How much cash do you guys have in the bank? Still 50, right? So whether I give them check, cash, or stock, they have the same gift. From a tax reporting perspective, 50-50, it doesn't matter, does it? Now, there's some rules about how much you give, and I'll show that in a minute. But from this exercise, if I give Jessup that 50 right there, and I claim it, and I drop it over here, and I go from $1 million down to $950, technically I just saved $25,000 in taxes, didn't I? And that's where most people's brains turned off. The reality is, by giving the $50,000 of stock to Jessup, I just made $15,000. I want you to think about that for a minute. Remember, I gave Jessup $50,000. Technically, how much money do I have in that gift? I've only got 10 in that gift. They just recognized $40,000 of gains tax-free, and for me, the donor, I still claim 50, but that 50 is really 10, isn't it? And then when I push that puppy over here on this side of the tax return, and I get that $25,000 tax benefit, 10,000 basis, I just made 15,000 bucks. My point that I'm trying to share with you here is when you get ready to write a nice check out to the university or a church or something, if it's going to be something with a couple of zeros and some dollars on it, you need to be looking at your real estate and your investment portfolios, and when you've got something dead on arrival like that, cull it out. Give it to the church, whatever, and then I began this exercise with, I'm going to give William Jessup $50,000. Where's my checkbook? Take that checkbook, go over to your financial planner, stroke that check for $50,000, put that in the stock market. Now I've got $50,000 with a new basis over here, hopefully going to do this. You made money and you just became financially better off. Does that make sense? That's in my book. This is how to give with tax efficiency and make money doing it. Now I'm going to build on that concept. So does everybody have this? Because what if we were to do this selling a business? Oh, wow. So tax loss harvesting, the term here is charitable tax loss harvesting. Don't worry, your lawyer, your accountant, your banker, your financial planner is going to look at you like you have lost your mind. You're going to have to teach them. Or they can buy my book on Amazon for $18.61. Without question, I can do more on a tax return with Schedule A, line 14, than anything else you have at your disposal to make you money like you could never believe. Are we going to change charities by doing things like this? Imagine if the entire country started doing this. We started solving problems at the charity level and got the government out of solving problems. Remember, it cost them 73 cents on the dollar to solve a problem. William Jessup is solving problems for a nickel. Make sense? So retirement planning, when I'm working with business owners, some have an IRA, Roth, 401k. Most people understand this. So, for example, Phil, if I make $1 million a year, where's Phil? If I make $1 million a year, how much can I put in a traditional IRA? Did I make too much?
Traditional, yeah.
Oh. So there's rules on how much money you can put in these things if you're a business owner with income, wages, et cetera. But when you're a business owner, it's all about access to capital, it's all about tax deductions, and so sometimes I'll tell folks, you know, we need to be looking at sheltering some money over here, because if I'm 55 years old making $1 million a year, W-2 distribution wages income, I can shelter $250,000 to $300,000 over here. So instead of having $1 million of taxable income, I shelter $250,000 there. All I got to pay taxes on now is $750,000. I still got to pay taxes on this down the road, but I don't have to pay taxes today. Phones to stun. So what if we were to correlate pension planning with charitable retirement tax planning? What if we were doing both? I remember the goal is to pay the least amount of tax, right? So if the cash flow or the assets are there, why aren't you doing both? I could be here for days talking about different types of charitable structures. This is just a handful. The point is, do both. I will articulate this. If I'm putting money into some type of tax-deferred strategy at an unknown future tax rate, remember we all agreed earlier, we believe taxes are going to go up. So why in the world are you putting $1 over here when you know taxes are going to go up? I will agree with this all day long, provided you're also exploring how to liberate that money on the back end. How can you get the money out with tax efficiency? If you're not doing that at the same time, you have no business putting $1 in a qualified plan. Just go ahead and pay the tax. But if you are going to do this, have an exit strategy for those dollars, because they're going to be painful. So with $1 million of taxable income, from a charitable perspective, I could give $600,000 to William Jessup. So let's go through this exercise. I made $1 million this year, and we decided to give William Jessup $1 million cash. Here you go, Tom. As a taxpayer, can I claim that entire $1 million this year so I have zero tax? No, I can't. There's a cap, 60%. I can claim the first $600,000, but the $400,000 I've got to pay taxes on. And the unused deduction I can carry forward to next year. If I give William Jessup securities or real estate, there's a cap of $300. So when you're balancing pension planning and charitable planning and you're looking at the assets, there are some structures in respect to how much and how often. Okay? Make sense? Chapter 13 in my book. This is called charitable retirement planning on steroids. Because when I work with a business owner, it is always about a handful of things, one of them being able to retire in style. Some other deductions. It is amazing at the number of transactions I've worked on where people should be doing R&D tax credits. The operative word here is credits. That is a dollar for dollar benefit. It is amazing how many people aren't doing this. Yet it is a specialty type thing. Only a handful of CPAs are doing it. Chapter 6 in my book. If you're exporting something overseas, there's a thing called an IC disc. Here's the legal term for it. Interest charged domestic international sales corporations. Don't worry, the lawyers can't even say it right. So they call it IC disc for short. So if I'm exporting stuff overseas, there's another tax shelter here for me to shelter money from taxation, which is kind of cool. Chapter 7. I have a building, and we have all types of specialized equipment in here. Wouldn't it be cool to accelerate the depreciation on that piece of the building? So if I can accelerate the depreciation, does that mean more cash flow to my pocket today, business owner? Uh-huh. Charitable tax planning basics. Real simple, chapter 11, then chapter 13. Where you can start blending things. Here's another one. How about hiring people who maybe are not very hireable? Somebody fresh out of prison, somebody on food stamps, veterans who are disabled. There's a ton of those tax benefits too. Don't worry, they're not going to call you and tell you how to pay less tax. You have the right to overpay your tax. But if you want to pay less tax, and many people are already doing this stuff, they're just not doing the work to get the tax break. And those are kind of specialty things, okay? So when I work with a business owner, it is always these three things. I want to sell when I won't. Here's my concern about that. A lot of us advisors work with people to say, let's pick an age that you want to retire and sell your business. All right. It just so happened that the age I picked was the year 2008. Not a good year to sell your business, is it? So maybe picking a date or an age is not the most perfect thing. I like to advocate here, sell when it makes sense. When the economy's hot, interest rates are cheap, yeah, maybe I'm 4 or 5 years from retiring, but in 4 or 5 years, is it still going to be cheap money, hot economy? Yeah, you got to think about that. For the money you need. Here's another thing that people have trouble with. Have you done a preliminary financial needs analysis to determine what that number should be? I mean, how much is enough? The reality is many business owners already have that. So then my question becomes, why are you still working? Is it for the money? Well, no, we've got enough money. So why are you still working? Loyalty with employees, friends, vendors, community involvement. Oh, so you're working because it's fun. Okay, that's fine. But you already have financial independence. Some people just don't know what the number is. You need to know what the number is. And then to the persons you choose, this is a loaded one. Most business owners want an inside sale. They want to transfer to key employees or family. What's the problem when I transfer my business to some key employees? How bankable are they? I mean, does anybody have any multi-millionaire employees working for them right now that can buy them out? It just doesn't happen, does it? But most business owners want that. What are some of the reasons why business owners want to sell inside? What if the outside buyer comes to the table and says, as soon as we acquire your firm, we're closing this place down, laying everybody off? Oh yeah, that's what I want to have people remember me for. This is a tough discussion. If you're going to do an inside sale, how much planning do you need to make this work right? Have the right person ready, trained, bankable, you able to exit? 1 year? I got a 5 over here, 5, how about a 6? I got a 5 back here, 5 and a 6, and how about a 7? No less than 5. 10 is even better. Okay, I can do miracles with more than 5 years. Because remember, there's a tax event that's going to happen here too. So inside sales, this is reality. Less than a third actually happen. You can do something like an employee stock option plan or a fractionalized ESOP. There's lots of ways to structure those, but those need to be kind of for bigger companies. You don't see this for $1, $2, $3 million companies, and not for 5 or 10 employees. There needs to be a lot of things going on here. Phantom stock is another way. So let's say that I've got a business that's great, but none of the employees want to be an owner. They want to be employees. You ever heard of that? Some people never want to be a business owner, but they're great employees. So what if I need to bring in outside talent, but I can't afford them? So using some type of phantom stock plan is a way to bring in that talent and let them participate in the upward sale of the company one day. If you got a C Corp, maybe you can do some type of 1202 transfer. This is another fancy thing for the lawyers. The reality is we end up with about 2/3 outside sales because it's quick, simple, and we can make it happen real fast. But there are risks with it. There are risks with it, just like anything else. And you can defer some of these tax issues, earn out. And by the way, does all the business owners know that inventory is ordinary income? It's amazing how almost every transaction I'm sitting in, we got $2 million in inventory and that's going to be ordinary income. Yeah, you got to understand the nature and character of what you're selling. 79% of business owners plan to sell in the next 10 years. Remember, they got this huge baby boomer curve going on. It's amazing. 75% would sell today if their financial security was assured. 80% believe that a successful exit is because of careful planning. In other words, tax planning exits too. 78% have discussed this with their family. But only 18% have actually talked to somebody who knows how to do exit planning. Now granted, we need wills, we need trusts, we need purchase agreements, key man policies and stuff like that. But to do tax efficient planning is a lot more than just that. 38% of business owners have done nothing at all. Here's the reality. 100% of business owners will transfer their business, either dead or alive, divorce, disability, dissolution. That business is going to change hands 100% of the times. The question is, are you going to be in control of it? And is it going to be tax friendly? You have to be in charge of that. And then to add insult to injury, we sell the business, we walk away with $5 million net proceeds. We lost 1/3 to 1/2, depending on your structure, S Corp, C Corp, et cetera. And then we take the net proceeds and we put it back into the taxable environment. Wonderful, this is great. And so just because you're talking about the transaction in respect to doing some tax efficiency planning to exit with the most money possible, you've got to take the next step. So when I walk out the door with $5 million in my bank account from the sale of my business, from a litigation perspective, we're my litigation lawyers. I've got $5 million sitting in my joint checking account at the bank. Is that subject to litigation? When it was in the corporation and the LLC, I had at least a degree of asset protection, didn't I? So it's an issue of both exiting with tax efficiency and realizing that when you walk out the door, you're totally naked when it comes to asset protection. You've got to take steps to protect it. Yeah, lots of tax. So what if you could sell tax smart? So what if we had a business owner who owned the building, $5 million, paid off, fully depreciated? I already know you're going, hammer. And then a $5 million S-Corp. The goal is to sell with the least amount of tax. What if we were to take part or all of that building and put it into a charitable trust? The part we put over here is going to be a zero tax sale. The charitable trust becomes a pay strategy for the client. And the income coming out of the charitable trust is going to be a mixture of income tax and capital gains tax. So that's some tax efficiency there too. And then because we put maybe $4 million of the building into the charitable trust, is that an income tax deduction that can land on my 1040? Well, it lands on my 1040, and then when we do the 8594 for the transaction of the business, we have a $5 million transaction. That comes over. Now we apply the $4 million charitable income tax deduction. We began this exercise with about a $4 million tax bill. Now what's the tax bill? It's going to be less than one. Amen, hallelujah. You've got to be thinking larger than just, here's the transaction in front of us, let's worry about the purchase agreement. You got to look at the big picture on these things. It makes sense. You need time to do this successfully. Sometimes some deferral strategies work as far as doing capital gains deferral strategies. The ESOP thing I really like, but you got to be really careful with it, and they are expensive. Got to learn how to shelter money over time. And then the reality is, if you did efficient tax planning every single year, the goal could actually be to transfer your business and not need a dollar out of it, particularly if you're trying to do an inside transfer. That is amazing when you do it that way. I've created the lifetime and the income that I need so that I can exit my business in total control. I transferred it inside, and now my legacy truly gets to stay intact. But I can't do this in 10 minutes or even 10 days. It takes time. So if we could sell tax smart, literally in just a matter of minutes, I've taught you how to pay less tax, how to never pay capital gains taxes ever again, how to grow your business value, increase your retirement options, give more now, give more later. And the funny thing is, none of us are defining these objectives to correlate with that. Almost all of our advisors, I mean no disrespect, camp out right here. Numbers are safe, clean, there's no horror stories with them, it's just numbers. Start looking at that. What is your family mission statement? What if you were to have a family meeting where your goal was to give away $1 million during your lifetime? Here's your homework. In your white folders, remember you're all going home with homework, you are in a university. And if you don't pass this test, you're coming back for remedial training. There's a flyer in here that says top 12 business continuity questions, okay? This is to go home and ask yourself these questions about your business. And if this doesn't look good to you, then you have some risk. This is all about if you died today, became disabled, is your business going to continue to flourish, or is your business going to be sold at a fire sale in 3 or 4 months? This is how you prepare for the what if, oh my gosh, it happened to me. It never happens to me, it's always somebody else. So this is the emergency continuity questions you need answers to. On the backside, now that we've solved the emergency issues, I want to start thinking about building value, paying less tax, and transferring my business in a controlled way. Here are the top 10 business succession questions. Yeah, you need a will. Yeah, you need a trust. Yeah, you need key man. This is what makes the difference. Okay? There's also another flyer on the left-hand side called the 5 critical elements of a successful exit plan. And it kind of gives you a little chart on the front and then on the back a description of these various things. But do you know what's funny? Every single transactions I've done, I'll ask the business owner, have you ever read a letter of intent? You know, a letter of intent to buy your business. No. But I'm getting ready to sell my business. Wouldn't it be a good idea to understand what a letter of intent might look like so you can start understanding these words and options and how these designs are, other than just running out to the market going, hey, I want to sell my business, where's a business broker? You got to start understanding this game. Unless you've sold 2 or 3 businesses in your life, this is going to be a huge surprise and an emotional roller coaster that you were not prepared for. So you got to start thinking about this stuff. This starts making it happen. And if you're a professional advisor and you want copies of this, I've got some extra copies up front if you'd like to have it. I also put $1 million in here. So if you want to go ahead and take that down to the bank and try to cash it, good luck. But it's funny how we have that. But imagine being able to have that objective to give away $1 million either while you're alive or upon your passing. Here's the most painful phone call I get, and I get this so often it's hilarious. Ed, we saw your seminar a couple of years ago and loved it. We just sold our business. We're closing in 3 weeks. We got a $12 million tax bill and want you to come fix it. Oh, yeah. I can do that in 3 weeks. No, I can't. You can't do that in 3 weeks. But it's amazing how often I get that call. We've already listed. We've already sold. Purchase agreement's done. Terms are done. We're just waiting on the check. There's not much left. You're going to write a big check, and it's not going to be to your checking account. Today, I have a monthly newsletter that goes out twice a month. 500 to 600 words, easily written, almost written in Southern language. Talks about exit planning, business, that kind of stuff, kind of cool. Go to my website. I've got about a dozen white papers on there, but this white paper here, Exit Paths for Business Owners, this is beautiful. It's about 9 pages, and it puts the framework, S Corp, C Corp, inside sale, outside sale, ESOP, outside. It's beautiful. If you want an appointment to stand and talk, send me an email, give me a phone call. We'll start talking about things. All right, did we learn a little bit? All right, the key thing I want you to take away from today, the most important part of your tax return is Schedule A, line 14. Start learning how to use it. I met with a gentleman 2 years ago, 800 employees. His income tax was 14.7. I mean, his income was 14.7. His tax bill was 6.2. $200 million estate. And he's all upset about having to stroke that check for $6 million again. And I'm sitting there talking to him, and I met with him and his CFO, and I said, bring me your tax return. I didn't know I was going into this kind of meeting with 800 employees, so the tax return occupied 2 tables. The reality is, you did overpay your taxes by about $2.5 million. How happy you think that guy was to learn that? When I went to Schedule A, line 14, to see what his charitable contributions were, remember he made over $14 million. What do you think his charitable contributions were? 17 grand. He doesn't need another dime. Net worth in excess of 200. And he is philanthropic, but he doesn't know how to be philanthropic. Over $2 million he paid in taxes. And then he got to thinking about the year before that, and the year before that, and the year before that. As I spent time with him, he wants to solve the homeless problem. And I says, how much money do you think it's going to take to solve the homeless problem? He said, I think I can do that for $1 million or $2 million. I'm like, no, that's not a down payment. You're going to need about $250 million to solve it here in Sacramento. I said, but you know, you could do that. You got enough friends. You serious about solving the homeless problem? You got the money. Let's go solve it. So what I want you to leave here energized to do today, think about what you want to go solve. What do you want to change? What do you want to make better? It's always going to evolve around how do we get the money to make it better. Yeah, you got to pray, but it's going to need some money to make it happen. Hopefully you learned today that if you just adjust a few things, you can make some money fall from the sky. And let's do it that way. Any last questions before we close?